I was listening to some panels earlier this morning. Some themes have been reoccurring throughout this conference. The BRICS taking over, de-dollarization, world order shifting. And do any of these themes resonate to you? Does it matter?
The answer is yes and no.
Okay.
Yes, these things matter.
Right.
These are global mega trends. I think they're real. It's happening. And
Are they real? Let's just
yeah. So, for example, the de-dollarization thing. My fellow Puerto Rican Brent Johnson, the dollar milkshake guy, right? He keeps talking about how it's going to take decades and don't worry about it. And I agree with him. But it is happening. It's not a question. Is de-dollarization happening or not? Really, the question for me as a speculator is, does this inform my decision making now? Eventually the dollar gets dethroned. I have no question that's going to happen. These are global megatrends that take years or decades to play out. It has zero influence on my decision making as a speculator right now.
We're live at the Vancouver Resource Investment Conference 2024. Joining me right now on the floor is Lobo Tiggre, CEO of the IndependentSpeculator.com. Audience members of my show will have seen Lobo on my show several times in the past year. Welcome back. Good to see you in person finally. 5 months ago, I had you on the show. You were telling us about how the economy may break by the year end into this year, perhaps. Are you pushing the timeline back? Are you sticking to that thesis?
So yes and yes.
Okay.
Right, Team Soft Landing is out there running victory laps. It really pisses me off, if I can say that on your show, that it seems like a concerted effort out there to conflate no landing, no recession at all with soft landing. That's not what the term means. Soft landing means a mild recession. And that is actually the mainstream view right now. Most economists out there still think there's going to be a recession. It just won't be so bad. Yay. But you look at the talking heads on financial media and it looks like they're all like, no recession, everything's fine. And that's not what the term means. It's misleading, I think, and it's dangerous for investors out there. But to answer your question, why this is relevant is, it looks like I was wrong, and I can say that my call last year that we would see something break by the end of 2023, categorically that was wrong. But nothing has changed. The setup is the same. I still think that the post-pandemic labor hoarding and distortions in the economy have made those famously long and variable lags longer than they have been perhaps on average. But even that, we're just now getting to that average length. In fact, RBC just came out with some new numbers saying that the average length for US policy shift to tightening to recession is 27 months, which is longer than I've heard. My friend Adrian Day likes to say 24 months. I've heard as little as 18 months. Whichever number you pick, we're just now getting to where you would start to expect the recession to hit. So all these victory laps of, everything is fine, I think is at the very least premature. It's not safe to make that conclusion yet. So between that and all the, it's like 20 to 1 indicators that are flashing recession versus everything's fine. The labor market and the consumer spending are the two things that look like things are fine. But you also look at the credit card debt and the buy now, pay later things, and all that spending, in my view, is not necessarily a positive sign. And you look at the labor market, and again, post-pandemic hoarding, I think that's a masking. I think we've spoken about this. I think this masks the true state of the economy, and that explains why everything else is flashing red. You look like you had a question.
Well, yeah, several follow-ups. The first thing is that I'm asking you this question because I want to gauge your sentiment for this year. If you are pushing the timeline back on a hard landing, for example, wouldn't that change your stance on whether or not to go risk on, risk off? For this year, at least.
Yeah. Broader markets, yes. I am doubling down, so I'm not backing off. I do still expect the hard landing. The timeline has been pushed out, and predictions are hard, especially about the future, as the saying goes, right? So I may have to have a double serving of crow if we don't see it. But I do think we see the recession become undeniable this year. And I'm going to go out even more on a limb with you, David. I think we see it, if not this quarter, then by this summer. And if I'm wrong, that RBC 27 months says maybe it starts in July, August. So I do think by the end of the year is a relatively likely scenario. If I'm a broader markets investor, the impending recession, certainly that is not encouraging me to go risk on. If I'm a monetary metals, investor isn't really the right word. If I'm buying gold, I really don't care. I'm buying it because it's real, it's physical, it's got value, it's savings. if I'm speculating on the gold-dollar exchange ratio, via gold stocks or something, well, then I want to be ahead of that. I don't know when it happens. I'd rather be early than late. And we've got this wonderful situation where gold is doing great, right? It's held up in the face of higher dollar, higher interest rates. That now we have this impending, apparently the Fed has beaten inflation, and supposedly that's supposed to be bad for gold. All these headwinds, and yet gold keeps holding on. So gold's doing great, but the gold stocks haven't. The gold stocks, on average, or as a group, as an asset class, have greatly underperformed. So either, the market's telling us either gold comes down to the gold stocks or the gold stocks come up to meet gold. And I think it's going to be the gold stocks going up. And for anybody who's not long already, I think that's fantastic. There are bargains in this space where, for a generalist investor, do you want to chase the Magnificent Seven at these levels?
Right.
If you're a uranium investor, uranium is, I know we'll get there, uranium's done great, but do you want to chase the high-flying uranium stocks at these levels? They're not bargains, whereas there are great gold stocks that are bargains, and I think that's terrific.
Let's talk about gold. You brought that up. Gold stocks will catch up to the gold bullion. Are you then suggesting that the equity markets will also catch up to, well, they already have caught up, but the equity markets will rise this year into 2024? Because why would the miners rise and the rest of the equity markets, tank, for example?
Well, let's pull back to the macro a little bit, because there's a couple ways to look at this.
Right.
First, historically, recessions are great for gold.
Okay.
Right, and silver's following gold again. Yay, silver bugs. Even Darth Silver admits that silver's back to following gold again. So that's good. But the setting, though, is pretty complicated. A recession should be bad for the broader markets. And when you get this big wipeout, right, if there's a crash, then everything goes on sale, including the gold stocks, even if that's your leverage way to play the safe haven. And we've seen this before. We saw it in 2020, 2008. This is a tried and true pattern in the markets. And there are plenty of pundits out there who are calling for a crash and saying, oh, it's going to be bad, get out, get out. My pushback on that would be, not just the Fed, but Washington, the powers that be in general, have trained the markets to expect rescue. And the extreme sort of case of bad news is good news, we saw this in spades in 2020. That was bad news. Like, it was horrible for markets. Everything, the markets should have fallen down and never gotten up with, who knows how the pandemic was going to turn out. And instead they went nuts. Instead, we reached all-time highs. I mean, we got new all-time highs now, but remember, after the crash of 2020, we went roaring back in mainstream equities, in risk assets, in a risky world, because the Fed had their markets back, right? Because Washington sent out the money helicopters. So all these people who are assuming that a recession this year, even if they're right, it's going to mean stock markets go down, everything's going down, they're forgetting that the powers that be have shown that they're unwilling to let a recession happen. And I'm not back walking my call for recession. I'm saying that as soon as it appears and it becomes undeniable, I think they're going to unleash the money bazookas. And so there's a chance here that instead of prompting a crash, it actually prompts a rally. That bad news will be great news for Wall Street.
Especially the Fed eases on their monetary policy.
Right.
I was listening to some panels earlier this morning. Some themes have been reoccurring throughout this conference. The BRICS taking over, de-dollarization, world order shifting. And do any of these themes resonate to you? Does it matter for you to look big picture at the world and how things are? You're a resource investor, yeah.
So the answer is yes and no.
Okay.
I actually, and I'm not waffling, I actually literally mean that. Yes, these things matter.
Right.
These are global mega trends. I think they're real. It's happening. And
are they real?
For example, the de-dollarization thing. My fellow Puerto Rican Brent Johnson, the dollar milkshake guy, right? He keeps talking about how it's going to take decades and don't worry about it. And I agree with him. But it is happening. It's not like neither he nor I am saying it's not happening. And if you look at the dollar's share of global reserves, every year it goes down. So, it's not a question, is de-dollarization happening or not? Really, the question for me as a speculator is, does this inform my decision-making now? And there I'm going to side with Brent. Like, eventually the dollar gets dethroned. I have no question that's going to happen. Whether it's a BRICS gold-backed currency or, who knows? I don't know. Right. But these are global megatrends that take years or decades to play out. It has zero influence on my decision making as a speculator right now. Like, which stocks am I going to buy? Which commodity am I going to bet on this year? I don't.
So why are people talking about it then? If it has no implication.
So that's why I said yes and no.
Right.
Well, it does matter in that it's important to have a context, to understand a lens through which to look at the world, to understand what's happening. And the bigger picture informs that. Things make better sense with that. Or let me put it this way. Have you ever scratched your head and looked at how insane the markets react on the tiniest little data point? Like if we get a blip in the unemployment rate or the CPI print or something like that, has the world really changed from yesterday to today that much? And yet the markets are acting like Armageddon's here or Nirvana, right? And then the next day you get a different data point and they go the opposite direction. It seems schizophrenic, or I don't know, I'm not a medical doctor to put the right term on that, but it's crazy. Why are the markets so crazy? Markets full of intelligent people with millions of dollars to throw at these analyses. Why are they so crazy? Because the Fed is data dependent, therefore the Fed watchers are data dependent, and therefore every time this new data point comes out and they plug it into their models, the models tell them what to do and they do crazy things. And since so many of the people have similar or identical models, there's a crowded trade with every data point. And so you see these huge reactions and the robo traders pile in and you get these outsized market responses to really tiny incremental changes in the data. So this is why it matters. This is why a thesis about de-dollarization or what have you, it does matter to understand the broader world and to be anchored. And to quote a Democrat here, I'm not a Republican or a Democrat, I'm a libertarian, but the guy they have on Bloomberg all the time, his name is on the tip of my tongue. Very senior guy, was an Obama administration. Larry Summers, right. He's been critical of the Fed, and he's often said, you have to have a context. You can't be completely data dependent. You have to have a context in which you look at their decisions, and he's encouraged them to not be so, wishy-washy. And others have made this point too, and I think that's right. You can't be entirely data dependent, or else you end up making crazy decisions on a day-to-day basis.
Let's back up to the commodities. Which commodity or set of commodities, plural, have consistently done a good job in forecasting economic growth and contraction?
Well, Dr. Copper takes the crown on that.
Okay.
And Dr. Copper doesn't have great news for us right now.
No, it's down just on a one-year basis. I'm looking at the chart right now, quite a bit, right?
Yeah. So it's funny. It's just one of these 20-to-1 indicators that, to my mind, reinforces my view that the recession is happening, and I will be shown right. Now, either I'm right or I'm wrong. Let me take this conversation curveball in a different direction. What I like about the setup, you asked me actually initially, what's my feeling, what's my outlook going forward? Normally, I'm the professional raid on the parade. I'm the guy saying, wait a minute, the BRICS currency isn't going to save us tomorrow. I'm the guy trying to put the reality check on us, right?
Yeah.
So I'm actually exceptionally optimistic about this year. Because the setup that we have here, if I'm right about the recession, gold's going to do great. Our gold and silver stocks are going to do great. We're going to have terrific buying opportunities on copper, oil, maybe lithium too, other things for after the recession. It's a wonderful setup. And if I'm wrong, then the very large allocation to uranium that I've got in my portfolio is going to do even better. So I see this as a case where I have the two yellow metals hedging my portfolio this year. If I'm right, the best part, what has me excited, this is the equivalent of me pounding the table.
Sure.
What has me excited is, if I'm right, we get the recession. Uranium is kind of recession-proof. Whether there's a recession or not, you still need the uranium for your nuclear power plant.
Let's talk about uranium right now. The audience watching this is wondering, why on earth is it 106? Okay, this line, you've heard of the adage, whatever goes up in a straight line has to come down in a straight line. Has it come down in a straight line yet?
No. If you look at the chart, it's actually kinked a little bit sideways at the very end.
Okay.
It's somewhat of a, still up, but flattish to up weak.
Just some context for the audience, okay? In June 2023, which was 6 months ago, it was trading at 58. It's now at $106 per pound.
Almost a double.
Almost double in a matter of 2 quarters.
Let me pause and just say, for all the people out there who think that cryptos are the only way to get crazy zany gains in a few months, this is an example that no, metals and mining can do this for you as well.
Correct, but it's only done this, what, twice in its history? In the last 25 years?
There's other metals out there.
Right. Okay, so what happened to uranium?
Okay, so my friend Rick Rowe,
Yes.
who we'd like to interview as well, he likes to say that the big thing, the catalyst the market was looking for was Japanese nuclear power plant restarts. And that is happening now. That started happening in 2023, or actually earlier, but it gained momentum last year, and that has really changed the market. You took very large sellers and you turned them back into buyers, at least, or non-sellers. The setup for that was, this is older news, but we had SPUT, the Sprott Uranium Trust, cleaning up the cheap pounds that were available on the market. I agree with Rick about that, but that's just, I don't want to throw Rick under the bus. My view has been that more important is the signing of new long-term contracts. We had a lot of long-term contracts in the market at prices that looked good, 6 years ago, but now don't look so good. And those were holding the market back. They were also supplying a market that wasn't yet in need. And I was looking for new long-term contracts to be signed because there was no way at today's mining costs that new contracts would be signed at anywhere near, $20, $30, $40, even $50 a pound. The lowest contracts we've seen in 2023 were in the 50 to 60 range, the very lowest. So that, completely changes the market. It puts a floor under the spot price. And going forward, you're going to sign a new 5-year contract. You're not going to sign it at last year's prices. And where are costs going over the next 5 years? You need, a much higher uranium price. So this is something else that happened in 2023.
Sorry, when you say you need, who are you referring to?
You're the miner.
Okay, right.
I'm the miner, you're the utility buying my uranium.
Yeah.
And you say, oh, well, the spot, 6 months ago, you say, oh, spot's only $60. I'll offer you $60 a pound. Me as a miner, I'm saying, forget it.
I know the utility companies have a forward contract with a lot of these producers, right? Does this spot price impact their contract at all?
The spot tends to diverge because there can be a headline like Kazatomprom recently rocked the boat. There can be a headline that moves spot. The contract price, it's a long-term contract price. It doesn't necessarily wiggle. It changes when we get new disclosures of long-term contracts.
Right.
So it's less volatile. But it does anchor. If you overlay the long-term contract price with the spot price,
right,
you'll see that they wiggle with respect to the one or the other, but they don't diverge too far. So my view, and this is very bullish, is that long-term pricing is now putting a much higher floor under the spot uranium price than we've had in the past. I'm looking at least $50, $60 floor, probably $60, $70, $80 floor. And if that's the floor, and on top of that, you can see upside variance.
You and I spoke about uranium several times in the last couple of years. It's finally come to fruition that it's above $80 a pound, which is, I believe, 2 years ago, you told me that's the necessary price for production to be sustainable and economical, right? The production price hasn't changed. The break-even price is around $80.
No, not break-even, the incentive price.
The incentive price.
Right. So, or even $70.
Well, sorry, so what's the difference between break-even and incentive? What's the difference?
If you've already built your mine and you pay back your capex, and you're mining at, say, $40 a pound, right? And you have your G&A or whatever, so maybe your break-even price is 50, or you're mining at 30 and whatever. So you can break even at 45, 50 bucks a pound. If you're going to build a mine, though, you've got cost of capital, you've got capex. You need a much higher price to incent you to actually build more. So even if you're a miner, you're breaking even. Why are you going to build more capacity?
Are you then expecting more mines to come online then because of the incentive?
Well, they are. Like, we've already reached the incentive price. Yeah. And the low-hanging fruit, that's being picked now. The mothball production that we've seen from the existing producers, they're bringing that back online. Right. The companies, the developers that have low-cost projects, they're building those mines now. Yeah. Some of them are even reaching first production now. Like, this is happening. Like, high prices cure high prices. This is happening now. Now, here's the thing. Like, last year, my highest conviction trade for 2023 was uranium. This year, it's not. It's gold. Because this very thing you're bringing up, we've already reached the incentive price. And I love you, my fellow uranium bulls, but you don't want to be a blind bull, right? There's a sword behind that red cape. Don't forget that. Right?
Are you suggesting there's not much upside left?
Suggesting that caution is warranted. And I got to say, my thinking on this in the last couple weeks has changed because this news out of Kazakhstan where Kazatomprom has not exactly withdrawn their guidance, but they said they're going to be challenged meeting it and that their future guidance is at risk. That coming from the world's largest and lowest cost producer is a real wake-up call. And reading between the lines, this is not a fact, this is my interpretation, but reading between the lines, I think they're saying that they're going to be in the market buying to meet their contractual obligations because they can't ramp up production as fast as they can. They still have supply chain issues. They can't get all the sulfuric acid they need to mine their uranium. So this is a big problem. And they've also had construction delays, so it's not just the supply chain. And to give credit where due, Justin Huhn, the Uranium Insider, and other people were calling this before. Last year they were saying they're having problems. They're not going to be able to ramp up production as quickly as they're saying. Now, I'm the professional rain on the parade, right? So I saw that. Maybe he's right, but there's always somebody out there telling you, some expert saying this is a problem. So I'm glad to see it. Sorry. The answer to the question right now is that the incentive price is there, and so just looking at the stock chart going vertical, obviously that calls for caution. But at the same time, if you've got the world's biggest and lowest cost producer potentially switching to a buyer, that's a really big deal. Yeah. So even if we've exceeded the incentive price, it could actually go higher. And then on top of that, you've got the climate change agenda, the powers that be really waking up to the fact that they're going to need nuclear if they're going to come anywhere near meeting their goals. So this has the potential to become a flavor of the day.
I'm just wondering, if a new mine were to come online and we have to value the stock or whatever, what price are we using for the NPV? Are we using?
It's a guess, David, but we've run the numbers, and this was actually part of my thesis last year, my bull thesis last year.
I'm just thinking, I'll let you finish, but it's like, let's say if the new companies are valued at using $60 per pound.
Yeah, it's too variable. I wouldn't go there. The way I would put it is, I had actually thought before that this reaching the incentive price market would be in balance. That supply would meet the market until the low-hanging fruit was picked, and then we'd have the growing demand create a greater supply-demand imbalance in the future, like 2025 going forward.
Yeah.
But a very bright fellow who works for me, Konstantin, he helped me run the math. We have a new model on this. We looked, and actually, even if Kazatomprom had been able to reach nameplate capacity, even if Cameco had been able or is able to ramp up at McArthur River and Cigar Lake, these big mines, even with that and these development projects coming online, it's still not enough. Like, the low-hanging fruit is not enough to meet the demand now. This is not a new finding today. This was a new finding for me last year, which is why I became more bullish. So where I'm going, though, is that, but there's a new source of secondary supply. And that's all the people, it became after Sput went out and hoovered up all these cheap pounds on the market, that became like a fashion, right? Kazakhstan, they created a fund to buy physical uranium. Mining companies, they started buying physical on the market in order to sell in the future. This is a key point. Some of these, Sput is a one-way deal. They're not supposed to sell forever. But these other ones, they're buying physical as an investment. And the idea of an investment is buy low, sell high. That means at some price, these people are sellers. So this was a source of secondary supply that just didn't exist before. And there are optimists out there saying that even that's not enough. Yay, uranium's going to the moon this year. It's hard for me to jump on that bandwagon and say nothing can go wrong, because this has never happened before. This is new. I don't know how much of that secondary supply will hit the market this year. But if you bought it, some of these people bought it 30 to 40, some bought in their 50s. We're now at 106. Yeah. And they're looking at a double or potentially a triple for some of these guys coming soon. Why would they not sell? Especially if you bought it to fund building your mine. If you're one of these people that have mothball production and you bought cheap uranium specifically to sell later to pay for building your mine, no time like the present.
Let's finish on gold. Okay, we talked about gold a little bit, but it's your preferred commodity of 2024. Am I phrasing that right? It's
my highest conviction trade.
Highest conviction trade of this year. That's a strong statement coming from Lobo Tiggre.
Yes,
okay.
It is.
It's already above $2,000, right?
That's part of the excitement. That's part of why, this is me, the equivalent of pounding the table.
Incentive price for gold is already there. Let's put it that way.
No, actually, I would Okay, yes, the industry average, you could say, well, let's say the break-even cost is there. But what's the incentive price? The costs have
I
blown
understand
out.
gold is a
No, but I
very
know you're
different
teasing
metal
me.
from uranium, yeah.
No, but I would argue that we don't really know. The cost blowouts we've seen, the capex, I mean, we're not talking inflation adjusted here. We're talking 100% capex blowouts on some of these projects in recent years. Like if you've got a feasibility study that's more than a couple years old, just throw it out the window. Those cost figures are toast. So I don't know what the incentive price is, but it could be high. But gold is different, right? All that gold, almost, I forget the number, it's something like 95% of all the gold ever mined is still sitting on the surface of the earth in refined form somewhere. So mine supply is really not the key variable here. Gold is a fear barometer. Gold is a safe haven asset. It's about the macro.
So
But sorry, just real quick.
Yeah.
Going into, if I'm right about the recession, going into this very pro-gold setting, starting at a 2000 level, that's like, you remember going into 2020, we went into it at 1500, and what happened to gold? So if we go into that starting from 2000, just a 10% rise from here, David, takes us to 2200, which would be headlines all over the place.
But so when you're high conviction, what does that mean exactly? Are you suggesting that it'll go up more or it won't go down? Because if something doesn't go down,
It's more, it's more certain to have a meaningful gain this year.
I see.
So I always want to combine risk and reward here.
Yeah.
And so my best trades are not necessarily the biggest 10 bagger I can imagine.
Right.
Like if I was going to do that, maybe I'd go into lithium right now because it's so oversold. I'm looking for balance of risk and reward. I want the highest probability of the highest gain I can find. And to my mind, gold combines that this year. But key caveat, not tomorrow, not right away. There are near-term headwinds. The apparent victory of team soft landing or even team no landing right now, that's bearish for gold. So I'm looking more like second half or when the recession becomes undeniable.
People should follow the independent speculator for Lobo's picks in the mining sector. You can read more about it there. Give us your process. Tell us about how you select miners, green flags, red flags you look for.
Well, I know I have TA friends who just look at the chart. They're agnostic. They don't even care what the mineral is or whatever. There's others that follow the people. Like if it's a Ross Beatty or a Robert Friedland, they just buy whatever they do. There's different strategies out there. But you asked about my process. I'm very, very focused on the commodities I believe in. Like this is my highest trade for this year. So given that's where I'm at, I'm looking for gold stocks this year. My shopping list right now is all gold stocks. Because of this change in Kazakhstan, I'm putting uranium back on there. But because the uranium stocks are not as on sale as the gold stocks, I'm patient on that. Whereas I have a shopping list right now. I'm looking to deploy now. So I start with a commodity, and then I look for value. Are the stocks on sale? And then which ones? And then I get into my due diligence process on the specific companies.
Can you give us just one red flag that would instantly eliminate a project from your buy list?
The first one would be people. I have a little black book with people who have lied to me, or let's say, to quote Rick Rule, they have a track record unblemished by success, but particularly liars. Sorry, I won't name names.
Of course
but
not.
But yeah, people. Yeah, that's a non-starter for me, and I have actually missed out. There's sometimes liars get lucky, or sometimes they're really good at promotion, right? And the stock goes up even if the company never discovers anything. But I'd rather miss out on that than bet on somebody I know I can't trust, and then it goes down. I'd feel 10 times worse if I did that.
So you have a website, independentspeculator.com, and then Twitter, Due Diligence Guy. Where else can we? Is that it?
LinkedIn.
LinkedIn. Okay. All right. Well, fantastic. Follow Lobo in the links down below. Great seeing you, Lobo. Thank you for your time today, and thank you for watching.
Congratulations for the new show.
Oh, I appreciate it. Yeah, we've been on talking virtually for so long on the new show, but good to see you in person finally. Hope to see you again, and thank you for watching.